Hi guys, my name is Tanner. I work in finance. Today we're going to be covering Vega in under 2 minutes. What is Vega? Vega measures the sensitivity of an options price to changes in implied volatility. If you remember, implied volatility basically measures how the market feels the stock price is going to move. So if there's high implied volatility, they feel like the stock price is going to fluctuate a lot. If there's low implied volatility, the market expects the stock to remain relatively flat. For example, if we have a Vega of 0.1 and the implied volatility increases plus or minus 1%, then our options price will increase plus or minus 10 cents. There's a three-step process to how implied volatility affects an options price. If implied volatility increases, that means the probability of the option being in the money increases. More options will probably go in the money when the stock price is fluctuating like crazy. This makes the option more valuable. But the reverse is also true. If implied volatility decreases, the probability of being in the money for most options decreases, and then the option's value will therefore decrease. Vega has a few unique properties. One is that it's most expensive for at-the-money options, are most sensitive to changes in the underlying price, which would mean that it's also sensitive to changes in implied volatility. The other thing that is important is that Vega decreases over time. And the reason for that is because the expected move of the underlying will decrease over time. Think about it logically, 50 days to expiration, a stock 50 days from now could increase plus or minus 25%, for example. But then when we get down to 1 day to expiration, you're not going to see a 25% move in 1 day. You'll probably see around plus or minus 2%. So that's why Vega decreases. Quick example, implied volatility increases, Vega's 0.05. If our options started at $1, that means it's $1.05. If implied volatility decreases, Vega's 5 cents, then our option will be 95 cents. Hope that helps.